Well, what I discussed yesterday, try to recall. I started discussing risk analysis in investment. See, risk is one of the important factor, and this is one of the compulsory factor in every investment. I have shown you number of investment avenues. I have shown you number of investment avenues with their respective risk and return factor. And you will find there is no any investment avenue which is 100% risk free. Even some of the safest investment like government securities, bank deposits, we call safest investment. These safest investment are also subject to risk. What kind of risk? That is inflation risk. If you are expecting assured 7 or 8% interest offered by these government bonds or bank deposits, and if inflation rate prevailing is 4% or 5%, it means your return will be deducted by the rate of inflation rate. So due to inflation, there is no any investment avenue which is 100% risk free. Now coming to risk analysis. As I told you earlier, every investment is subject to risk, and investment is a very professional activity where you need to make proper analysis, proper inquiry, proper investigation, then coming to the conclusion where to make investment. Unless you get a particular signal that a particular firm is having potential or is likely to get return, then only you can make proper investment. From layman's point of view, risk means only possibility of loss. From layman's point of view. So far, I believe all of you are layman if you have not studied risk analysis. But being an investment professional, you have to study risk factor in detail. From investment point of view, there are so many kind of risk. Risk of life, risk due to accident, risk of default. There are many forms of risk. But here I will concentrate on investment risk only. The risk which is associated with investment. And that risk has diversible nature. So you have to study risk factor in detail. You will find some kind of risk is controllable, which you can control. A layman is not knowing whether it is controllable or uncontrollable, but you know it is controllable. And certain risk which cannot be controlled by some of the experts, we call systematic risk or market risk. So we have to study different forms of risk. Sometimes risk is prevailing in a company, and you may take risk. A layman is also knowing high degree of risk is there in a particular firm. You are also knowing, but that risk is easily manageable, which a layman is not knowing. And that's why you have to study risk factor in detail. You have to study various forms of risk. Various forms of risk. As you know, every investment is subject to risk. So here my discussions and deliberations will be only on investment risk. In the field of investment, risk is broadly categorized into two forms. First one is called systematic risk. Another one is called unsystematic risk. Systematic risk is called uncontrollable risk. It is manageable. It is macro in nature, which is prevailing like a system. For example, a kind of risk which is prevailing like a system. Nobody can do anything. You have to adjust, you have to compromise with that risk. We call it systematic risk. The meaning of systematic risk is very clear from its name. It prevails like a system. For example, take the example of current situation of coronavirus. This particular risk is prevailing like a systematic risk where every country is affected. Take the example of India. Every firm is affected. Entire stock market is affected. Last month, many companies were doing very well, but the moment this news came, started prevailing that it has impacted India, all of a sudden market crashed. All of you are well aware about this. So this particular information, this particular coronavirus risk has affected Indian market badly, and we call it a systematic risk. Another kind of risk which we can say is a systematic risk is like if recession is prevailing in the country or in the world, if a country or if an entire world is facing the problem of recession, and recession, you know, most of the activities are on decline, whether investment is concerned or profitability or performance of different individual firms or industries are concerned, all are badly affected. So systematic risk is that risk which prevails like a system where all the companies, industries and sectors are affected. You cannot do anything if such kind of risk is prevailing. Take the example of a stock market. It crashed from 42, 43,000. Once upon a time, Sensex was 42, 43,000. And how lower side it came. So nobody could do anything. Even some of the experts, finance minister or ministry or portfolio managers or fund managers, wealth managers, they could not do anything in regard to systematic risk. So broadly, we have two forms of risk. One is called systematic, another one is called unsystematic risk. Unsystematic risk that I will discuss later on. Let me come to systematic risk. Some of the examples I would like to quote. Systematic risk. If you are the fund manager, if you are the professional investor, investment advisor or wealth manager, you are guiding general public to make investment, you have to keep in mind, you have to understand it properly that whether systematic risk is prevailing or not. That will be your limitation. You have to let the client know that systematic risk is prevailing. Nobody can do anything. Even I cannot do anything. Some of the examples of systematic risk are if recession is prevailing, like coronavirus, this particular disease is prevailing. Also, for example, all of a sudden political unrest is there, political uncertainty is there. A particular government is ruling and all of a sudden the ruling party is disturbed and entire political system is collapsed. So what will happen? There will not be any clear political ideology. The ruling party is not ruling, and that's why there is no clear political ideology. And most of the companies doing business in consultation with the ruling party, and if ruling party is not ruling, it has collapsed, then obviously all the businesses will be affected. Maybe 20% or 30% business is affected, which is in support of the ruling party. But you know, market behaves like herd of sheep. If market price declines, investors starting withdrawing the fund from the market, and general public will also do the same. They will also start withdrawing fund from the market. So all of a sudden, market will crash. So another example of systematic risk is market risk. Some more examples like interest rate policy of the government. Suppose RBI decides bank rate, prime lending rate, deposit rate, CRR, SLR, repo rate, reverse repo rate. All these interest rates will definitely directly or indirectly affect all the firms working in the country. So any change in the interest rate policy will affect entire country, entire economy, all the sectors, all the industries, all the firms will be affected. Similarly, one more example is inflation rate. If inflation rate is suppose 7%, 8% or 9%, so that inflation rate will affect the purchasing power. Whosoever has invested, every investment will be affected by prevailing inflation rate. in the country. Why inflation rate will affect? Inflation always reduce purchasing power of the money. Inflation always reduce purchasing power of the money. So every business activity will be affected. Every business activity will be affected by the prevailing inflation rate. And that's why systematic risk broadly concerned with, or these are the examples: interest rate risk, market risk, purchasing power risk, inflation risk, country risk. These are macro in nature. These are uncontrollable. These cannot be managed by anyone. The only solution is, if you think, if you guess, or if you get an smell that systematic risk has started to prevail, the best way is to exit from your investment. If you think systematic risk is prevailing, the best way is to exit from your investment. A smaller loss is better than bigger loss. So that should be your investment policy. So try to remember, whenever you think systematic risk is there, interest rate policy of the government has badly affected the entire economic activities of the country. Market risk is prevailing. Market risk means any other factor which has badly affected the stock market. If a stock market is not doing well, most of the economic activity, most of the investments will be affected. So, and that's why there's one proverb, or you can say maxim: mutual fund investment is subject to market risk. So entire mutual fund industry, entire insurance sector, provident fund, pension funds, all broking firms, investment consultancies, individual investors, all will be affected. If all these will be affected, then those who are not affected will be indirectly affected. So if market risk refers to performance of a stock market. If a stock market is not doing well, nobody can do anything. Nobody can do anything. And if a stock market is not doing well, nobody can do anything. Every investment will be affected. And you have studied, it is in case of perfect competition market, individual cannot change the price. It is decided by the market forces, demand and supply. So if a stock market is not doing well, every investment in the country will be affected. Every industry, every firm, every sector will be affected. These are some of the examples of systematic risk. And the best solution to manage systematic risk is to exit from your investment at right time. Try to recall when I talked about investment. Investment refers to commitment of fund based on proper analysis, proper inquiry, proper investigation. Commitment of fund based on proper inquiry, proper investigation, proper analysis at appropriate time. Timing is also very important. Sometimes companies are very good, but timing was poor. Even in some of the best companies, investors may be loser due to poor timing of entry and exit. And that's why clever investors, intelligent investors are those who always believe in proper time. Timing is very important in the market. Enter at right time and exit at right time. Right time to enter is when prices are low, and right time to exit is when prices are high. So you have to go through information. That's why information is the basis for investment. Whenever you think systematic risk is prevailing, or it has started to prevail, its impact is likely to come, then better way is to exit from the market. These are some of the examples. These are some of the examples of systematic risk. And broadly, I may discuss market risk. If I ask what is market risk means it is the difference between expected return and risk-free rate of return. What is risk-free rate of return? Any investment avenue which is giving you return without taking risk. For example, in India it is 7%. if you invest in government bonds, government securities, fixed deposit in commercial banks, which is assured by Government of India and RBI, you will be getting around 7% interest. You are not taking any risk. It is assumed inflation rate is not prevailing. For example, assumption is inflation rate is not prevailing, then government securities, deposits in commercial banks are called safest investment. These investment avenues have 0 degree of risk. That is 7% return at 0 degree of risk. Assured return is 7%. When you take market risk, obviously, when you want to invest in a stock market, you are taking risk. And that's why you are expecting better return. Better means more than 7% return. If suppose the stock market is also giving you, after taking risk, stock market is offering you 7% return, but you are taking risk. It is subject to risk. And bank deposit is also offering you 7% return without taking risk. So it will not be a good decision to go for the market. People are going in the stock market or in the market when they are expecting higher return than risk-free rate of return. So if you take market risk, you are taking market risk, and that's why you are expecting more return. And now you have to understand what is market risk. What are the factors affecting market risk? If you go for a stock market, your returns may vary. It may be 15%, it may be 20%, it may be 30%, or it may be 5%, or there may be a negative return, and you are taking risk. These are the examples of market return. Broadly, I have discussed interest rate risk, inflation risk. All kind of risk are absorbed in the market. If there is any important thing is happening in the business environment, whether recession or interest rate changes or inflation rate is prevailing, any kind of political uncertainty, any kind of country risk, for example, all of a sudden you have seen when coronavirus started in China, a lot of investment was withdrawn from China. Initially, the bad impact was only in China. Later on, it prevailed throughout the world. So initially, it was a country risk in China. A lot of investment was withdrawn from China. Business activities were hampered. So there is a possibility that a kind of risk is particularly to a particular country. Suppose there is political uncertainty in any country. So stock market or market of that country will badly be affected. All of a sudden, there's a war between two countries. Unfortunately, there's a war between two countries. So these two countries will badly be affected. Their stock markets, their investments will badly be affected due to war between two countries. Suppose earthquake, something natural calamity, earthquake happened in a particular country. So entire market will be affected in that country. There is any other natural calamity, then also the entire market will be affected. So these are some of the examples of market risk, and market risk is an example of systematic risk. You can say systematic risk means market risk. Systematic risk, its impact will be on the market, and most of the investments are related, interconnected with the market. So broadly, again, you can conclude systematic risk is like market risk. And market risk, due to number of reasons which we cannot say, we cannot write down. There may be number of reasons: inflation, credit risk, interest rate risk. Suppose price of petrol, OPEC has decided to curtail oil production. So what will be the impact? All of a sudden, oil prices in international market will go up, and India is one of the largest consumer of oil in the world. So Indian stock market will badly be affected by the policy of OPEC, which has decided to curtail the oil output. Or maybe price has been decided. Suppose election in America, which are likely to held in the month of November. Donald Trump is current president, and again he will try for second term. So his winning and losing in second term will also affect Indian market. India is one of the important trading partner of USA. A lot of policies of current Indian governments are in consultation with America. It means a lot of trade has been done, a lot of investment has been done by Donald Trump government and by government of India. So if Donald Trump is not winning second term, then you will see market will badly be affected. And if he is winning, then market will show upward movement. Definitely it will happen. You can see in time to come. So any kind of risk, anything happening in your business environment which may affect so if anything is happening in the business environment which may affect directly or indirectly the market of the country, then it is termed as systematic risk or market risk. Now coming to unsystematic risk, it is quite opposite of systematic risk. The meaning is very clear from its name. Unsystematic risk is called unique risk, which doesn't prevail like a system where all the companies, entire country is affected. Systematic risk may be unique to a particular firm or particular industry or particular sector. For example, ABC Limited, workers at a strike, try to say. Manufacturing plant is closed. So in this case, entire economy will not be affected. All the sectors will not be affected. Entire industry will not be affected. That particular risk is due to workers' strike in ABC Limited. So ABC Limited will be negatively affected with this particular thing. Suppose all of a sudden you came to know, just like Yes Bank was doing well, all of a sudden you came to know there's some financial trouble in Yes Bank. All of a sudden, what happened? Market price of Yes Bank shares declined sharply. So that particular thing was in Yes Bank only. All of a sudden you came to know in a particular company like Satyam Computer. Once upon a time, it was a good company. It was doing very well. But one day morning you came to know there's some financial scam in Satyam Computer. Scam means obviously shareholders will be affected if there is any loss to the company due to scam. Who are the owner? Those who are owner of the company will be affected. So all of a sudden share prices decline for Satyam Computer. So if a scam happened, a strike or lockout happened in a particular country, or all of a sudden a technological change, all of a sudden entry of some new player, it is badly affecting the existing players. Just take the example after entry of Pepsi and Coca-Cola, it has badly affected all the soft drink companies of India. So all these are the examples of unsystematic risk. So unsystematic risk is called controllable risk. It is called controllable risk. It is called manageable risk. Such kind of risk can be managed. It is not affecting entire economy, all the sectors, all the industries together. If such kind of risk is there, what is the way out? How to manage unsystematic risk? You will not be badly affected. Suppose in this example, ABC Limited is affected to the extent of 50%. 50% market price of the share declines after this particular strike. So the best way is don't put all eggs in one basket. You have to diversify your investment. On the basis of proper study, proper analysis, you have selected 10 stocks and your total investment was in 10 stocks. And all these 10 stocks are doing very well. All of a sudden a strike happened in one company. So your actual total net profit will not be badly affected. the loss of ABC Limited will be offset by the profit of rest of the 9 companies. So in aggregate, your investment will not be badly affected if you have diversified your investment. And that's why diversification is one of the important component of investment, which a layman is not knowing. Even if I have seen some of the experienced investors know it very well that we have to diversify in order to minimize risk. But diversification is not a simple thing. It is a very technical term. Suppose 2 stocks you have to make investment, 2 stocks you have to make investment. The first problem will be how much to invest in A and how much to invest in B. How a layman is doing, how an experienced investors will do. Maybe they may guess 50-50 or 40-60 should be the ratio. So unsystematic risk is called diversifiable risk, and it can be controlled. It is a firm specific or a particular industry specific, and such kind of risk these are the examples of unsystematic risk, like financial risk, business risk, management risk. Management risk means like any scam happened, or management of the company is not doing well, management of the company is inefficient, management of the company is not able to handle a particular situation, and that's why there was a lockout or there was a strike by the workers, and there is unrest among employees due to management policy of the company, and management of the company is not able to handle the situation. They are not able to get maximum productivity from their employees. Similarly, financial risk vary from company to company. And what is financial risk? Financial risk is due to debt equity ratio of the company. Debt equity ratio of the company. And debt equity ratio vary from company to company. Company A, expected return 20%, which you have already studied in case of capital structure and leverage. Try to recall. In financial management, you have studied financial risk, that is financial leverage ratio. In accounting, you have studied. Maybe you have studied financial leverage ratio. That time only you remembered the formula and you got the answer and you were the happiest one. But how to know financial risk is existing in the firm or not, or how much risk is existing in the firm, that can be calculated. So being an investment professional, you must know the art of numerically expressing different form of risk. Take the example of financial risk. How it can be expressed in numerical form. When you are calculating financial leverage risk, you will come to know due to debt equity mix, how much financial risk is involved. If you calculate financial leverage ratio, sometimes, like try to recall, in leverage you have studied, there are 2 firms. There are 2 firms, A, expected return 20%, another firm B, expected return 20%. Both are looking quite similar in terms of nature of business, in terms of market share, in terms of product, in terms of clientele base. In every term, both the firms are similar, except debt equity ratio. If in company A, debt component is 20%, in company B, debt component is 80%, then your degree of financial risk is different. So that you need to understand, but that kind of risk can be managed. Similarly, business risk or operating risk, which you have studied in accounting, operating leverage ratio, in the form of operating leverage ratio. Business risk means operating leverage ratio. With the help of operating leverage ratio, you may calculate business risk. And how to calculate it? The ratio between this kind of risk will be due to fixed and variable cost component. If there is you will find plenty of manufacturing firms, maybe quite similar in terms of business, in terms of expected return, but in terms of fixed cost and variable cost, all the firms are different. So it means there is different component of business risk. Business risk will vary from one company to another due to difference in business risk. Is it clear to everyone so far? Whatever I have discussed, it is clear to all of you? Because time is less than 1, I have to reconnect, or I have to reconnect. Okay, good. Everyone